Today, we're going to take a deep dive into the two pillars of the U.S. stock market, QQQ and SPY. With this one video, I hope to ease your investment concerns. Let's find out which ETF suits your financial goals better. And more importantly, can you retire comfortably without worrying about money? I'm bringing together everything I've learned over the past 8 years of U.S. stock investing. You may remember the old commercial line, "A moment's choice can affect the next 10 years." Today's choice might shape your financial future. Let's learn together. QQQ and SPY flagship ETFs of the U.S. market. Which one is right for you? 1. What are QQQ and SPY? QQQ tracks the NASDAQ 100 index. It consists of the top 100 non-financial companies on the NASDAQ. It's focused on tech and growth stocks. Apple, Microsoft, Amazon, Nvidia, and Google dominate the fund. With high growth stocks, QQQ performs well in bull markets, but it can be more volatile in bear markets. If you believe in future innovation, QQQ might be right for you. SPY tracks the S&P 500 index. It covers 500 major U.S. companies across tech, finance, healthcare, consumer goods, and industrials. It includes not only tech giants, but also JP Morgan, Johnson & Johnson, and ExxonMobil. SPY represents the U.S. economy as a whole. It offers more stable and broad exposure. Great for long-term investors seeking market-wide performance. 2. Who earned more? Past returns. Past returns don't guarantee the future, but they give us perspective. QQQ's 5-year return is around 20% per year. Its 10-year return is about 17–18% per year. SPY's 5-year return is about 15% per year. Its 10-year return is around 13%. QQQ outperformed SPY in both periods. Why? Because tech stocks led the market. Especially after the pandemic, digital innovation accelerated QQQ's growth. 3. Who pays more dividends? ETF dividends work like stock dividends. QQQ yields about 0.5%. SPY yields around 1.3%. SPY pays more. That's because it includes mature, dividend-paying companies. QQQ focuses on growth stocks, which tend to reinvest earnings. If you care about income, SPY may be better for you. 4. Who charges less fees? Lower fees help long-term returns. QQQ's expense ratio is 0.20%. SPY's is only 0.09%. SPY is cheaper because it tracks a broad index. Management costs are lower. QQQ tracks a more specific sector, so it costs a bit more. 5. What's the smarter strategy? Let's talk about who should invest in each one. For QQQ investors, you believe in innovation and future tech. You're okay with market ups and downs. You want long-term growth from AI, chips, and the cloud. Use dollar cost averaging instead of lump sum investing. Adjust your QQQ share based on your risk tolerance. Take profits during market peaks if needed. Don't let QQQ dominate your portfolio too much. Balance is key. For SPY investors, you want to follow the overall U.S. economy. You're okay with average returns and low volatility. You value long-term stability. Reinvest dividends to grow your wealth. Stick to steady investing, not trying to time the market. Final advice: use both wisely. You don't need to choose just one. I recommend using both, based on your investment style. If you're younger and aggressive, go heavier on QQQ. If you're close to retirement, increase SPY allocation. Rebalance regularly, based on market trends and sector changes. This helps control risk and optimize returns. Both QQQ and SPY are great tools for U.S. investing. What matters is your goal, risk tolerance, and time horizon. Personally, I recommend a 40% QQQ, 60% SPY split. In our next video, we'll compare SPY with another big ETF, VU. Did you know Warren Buffett mentioned VU in his will? We'll explore why he chose it, and whether it's right for you, especially for young or new investors. This is essential information. When I started investing 8 years ago, I didn't have this kind of guidance. No one around me knew about U.S. stocks. YouTube wasn't very active either. I learned everything the hard way. That's why I'm confident this video can help a lot of people starting today. Not just the young investors now, but future generations too. Thank you for watching. This was Retirement Money Talk. See you in the next video.